Hey guys, this is Mrs. Scherenberg. This is our Chapter 7 lecture notes, and I will post this in Canvas, the notes, and this video lecture. This is Chapter 7, Internal Controls and Cash. There are several main ideas, but we are going to be talking about the Sarbanes-Oxley Act of 2002. It's also just simply referred to as Sarbanes-Oxley or SOX. And this act was passed in 2002. It applies only to companies whose stock is traded on public exchanges. So Koch Industries, for example, in Wichita is not a publicly traded corporation, so they're not required to do SOX. Its purpose was to restore public confidence and trust in the financial statements of companies. Sarbanes-Oxley requires companies to maintain strong and effective internal controls over the recording transactions and the preparing of financial statements. Internal control is broadly defined as the procedures and processes used by a company to safeguard its assets, process information accurately, and ensure compliance with laws and regulation. So if you were around in 2002, the news seemed to continually be about corporations who were cooking the books, if you will. They weren't being completely honest with their financial statements, and they were wreaking havoc for shareholders, for the employees. So Senator Sarbanes and Senator Oxley came together and created this act, and it required this new set of standards for these corporations. And it also, with the implementation of SOX, it held management responsible. And what I mean by that is now there were criminal penalties for those very top management, including $5 million in fines and or 20 years in prison. So now for your top CEOs of the company, they have to sign off and they have to say, yes, I feel that my financial statements are accurate. So back in around 2002 is when I started to go back to work after being home with kids, and I started out as a Sarbanes-Oxley analyst. And we would sit with, we would flow chart every significant financial process in the company. So if I was in charge of accounts payable, this would be a year-long process where I would meet with probably over 100 different people and sit with them at their desks and document every single thing they did, identify steps and processes which were key controls. And then I would test those controls to make sure that that process was working as intended. And all this to monitor and make sure that that our upper management could sign off and to make sure that we were truly had financial statements that were accurate. Okay, so this is straight out of the book, and this chapter starts talking about employee fraud. So employee fraud is the intentional act of deceiving an employer for personal gain. Management is responsible for designing and applying 5 elements of internal control to meet the 3 internal control objectives the 3 that we mentioned above. So here are the 5, and I do believe this is on the test as a matching question. But first of all, management needs to have a good control environment in place. So the control environment is the overall attitude of the management and employees about the importance of controls. 3 factors influence this: the management's philosophy, operating style, their organization structure, and their personnel policies. Okay, so you kind of know, maybe you've worked in a place that has really strong controls. They want you to do the right thing. They encourage you to do the right thing. Perhaps you've worked in a place that doesn't have a strong control environment. Maybe your boss is like, yeah, that's okay. We're not going to record that transaction, or it was a cash sale, so, let's not record that. So first off, you need to have a good control environment. Second, you need to do a risk assessment, and each business has its own unique areas of risk. Um, a large company that has a lot of employees has different risks than, say, a small company who only has a bookkeeper, for example. So you have to see, where's my biggest risk? Is it in my inventory? Is it in a employee type process that's going on? Then after you determine where those areas of risk are, you need to set up control procedures. Okay, so control procedures are something that are going to provide assurance that your business goals are going to be achieved. And some of those could be things like competent personnel, rotating duties, mandatory vacations, separating responsibilities, separating operations, proofs, and security measures. So for example, why would mandatory vacations be a control, you might ask? If you ever have an employee that doesn't want to leave, doesn't want to take their mandatory vacation, you want to be able to have people cross-train. And so everything is very out in the open, and no one is trying to hide anything and never taking a vacation for fear that they might be found out. Okay, number 4 in this control environment, these 5 elements of internal control, is it's monitoring. It seems like a strange word, but really what it is after you decide what those key controls are. So in accounts payable, for example, at Cessna, we probably had 30 key processes that we determined were key controls. So if I would monitor those 30, I would select transactions and actually make sure the control was in place. If it wasn't in place, or if I had like 1 or 2 things that escaped the process, I would have to select more transactions to test. If I still found that it was out of place, that the control was not working, then we would set up a corrective action. We would meet with the people involved in the process. We would set up new processes and procedures, and then we would implement that new control and then test again. And obviously, information and communication is extremely important. Question here, what could go wrong? Jose Muldoon's Mobile Foods is a food truck with 2 trusted employees. One employee stocks the food truck, prepares the orders, cleans up the kitchen. The other employee takes orders, collects payment, counts the cash, records the cash receipts, and deposits the cash in the night depository slot at the bank. What could go wrong here? Well, there could be things going wrong within both. We've got one employee taking care of all the food, and the other employee taking care of all of the payments, all the cash. So one employee could be really eating all the food, couldn't they? Or taking some home, or while the other employee could be tempted to take cash. What's going to prevent that employee from taking cash and just putting it in their pocket? Okay, so they need good separation of controls here. Going on, talking more about cash controls over receipts and payments. First of all, when we're talking about cash, we're not only talking about coins and currency, checks, money orders, but any money really on deposit with a bank, okay, that is available for withdrawal. This is all considered cash in our discussion. Cash is the asset most likely to be stolen or used improperly in a business. So businesses normally receive cash from 2 sources. When your customers are purchasing products, or when customers are making payments on a bill that they owed on account. So believe it or not, one of the most important controls to protect cash is a cash register. Many of you have probably worked a cash register before. If you have, you know that when you go in, if you're the one opening, a predetermined amount of money is given to each cash register clerk in a cash drawer, and it's called a change fund. Okay, so maybe you get the little money bag. This is the change fund, and you open up your cash register for the day, and perhaps it's $200, and you put this change fund in your cash register. Okay. Well, salespersons can make errors when you make change or ringing up sales, and sometimes that amount of cash on hand may differ from the amount of cash sales. Such differences are recorded in a cash short and over account. Well, if you've ever run a cash register before, let's say you're closing out the day, generally there's a couple procedures you go through, and you push this button and this tape comes out of the cash register, and it says, here's what the cash register recorded as cash sales. Then sometimes some of you have to count the drawer as well. So you count the drawer, you have all this cash, you subtract out the beginning change fund, right? And so those two numbers should match. The tape that comes out of the cash register should match the cash that's in the drawer. Well, doesn't always do that. So here is the journal entry, and we're going to be using a cash short and over account. So cash sales for May 3rd total $35,690 per the tape. Okay, that's the thing that came out of the cash register. After removing the change fund, we had $35,668 of actual cash in the drawer. That's a lot of cash. Okay, I don't know. That's a lot of cash. The cash sales and shortage would be recorded as follows. So first of all, the tape says this, like, hey, this is what should be, and the actual cash is this. So we are short by $22 if you look at those two numbers. Okay, so what does that journal entry like? So you put all this together, you take it down to the bookkeeper. The bookkeeper actually records this. It's 3 lines. The first line is cash, and the actual cash was 35668. Okay, and then skip a line and then record the sales. This is the cash register tape 35690. For this transaction for this journal entry to be in balance, this $22 is going to have to be a debit, right? So it'll be in balance. And this is where we use a new account called cash short and over. Cash short and over. By the way, this is an expense account. So it's in the expense category of the accounts. One of those that doesn't have the word expense in it, but it is shows up as an expense. Remember, when we increase an expense, it's a debit. So sure enough, this cash short and over is a debit. Well, we also use this same account if instead of it just being a debit, if there had been cash over, the cash short and over account would have been credited. Okay, so you debit it when you're short and you credit it when you're long. So let's pretend that we were over by $22. We had $22 more cash in the cash drawer. So this time you would record that bigger number as cash, and you would record the sales as the 35668 number. So this time we were long on our cash by $22. So this time it's a credit, and it's cash short and over is that account you would use. Okay, please make sure and read about the voucher system in your ebook. The chapter goes into why bank accounts are a good control. If you think about it, it reduces the amount of cash on hand. They provide independent recording, maintain it's like a record of everything that happened. And the book goes into several more reasons why just having a bank account is a good control. Well, you also receive this bank statement, generally email, paper. It's a summary received from the bank monthly of all checking account transactions. Okay, this is called a bank statement. It shows the beginning balance, any additions, any deductions, and the ending balance. So here's an example of here's the bank statement that you got from the bank, and here is a company's records for the month. Well, looking and comparing the ending balance of cash, it is different. So this company should determine the reason for the difference in these two amounts. This is a monthly process. It's called the bank reconciliation. You get the bank statement, you compare it to your company's records, and you figure out why the amount is different. Okay, so the objective of reconciling bank accounts is to control that cash So you always want to reconcile what the company's records are with the bank statement. Okay. In doing so, you might discover errors or misuse of cash. To enhance internal controls, the bank reconciliation should be prepared by an employee who does not take part or record cash transactions. Otherwise, mistakes may occur, and it is more likely that cash would be stolen or misapplied. Okay, so here on another video, I will show you how to do a bank reconciliation. But we're going to finish out this lecture talking about petty cash. Now, petty cash is something that's it is usually not practical for business to write checks. If you've ever worked in maybe a small business, maybe at the front desk there is someone there that has a drawer that's locked, and it's a little cash fund. Okay, this is the petty cash, a special cash fund. So here's an example. A petty cash fund of $500 is established on August 1st. So here's the entry to record that petty cash fund. August 1st is the date. We're going to debit petty cash for $500, and we're going to credit cash for $500. Okay, so think about it this way. You are working, you're the office manager, you're working the front desk, your boss comes to you and says, hey, I'd like to establish, a little petty cash fund so that you have it up front. So if any of our employees need to run to Ace Hardware or Home Depot to get a part, you can give them some cash, and then they'll bring back the receipt, so on and so forth. And he says, here's a check written to cash for $500. So what you're doing is you're going to the bank, okay, and you cash this check for $500. You get, that's why cash is credited here, because your actual cash at the bank is going down. But you take this $500 and you put it in your little petty cash bag. So now you have this new cash account, if you will. It's called petty cash. It has $500 cash in it. Then when someone comes and they need to go get a part, you'll say, maybe you'll give them $20. They'll go get their part. They'll bring back the receipt and the change, and you put it back in the petty cash bag. So let's say by the end of August, it's time for you to count all your petty cash receipts. And so here we go. It looks like we only have $30 of petty cash left on hand. Okay. Here are the receipts. So you've opened up your little petty cash bag. You have found receipts for office supplies, for postage, for store supplies, and for miscellaneous administrative expense. Those receipts total $467. In addition, you only have $30 of cash on hand. So you started out with $500. You're $3 short. Okay, this is going to happen. Let's say you send out an email to everybody, hey, does everybody turn in their receipts for if you've used petty cash? No one comes forward. You're just simply off $3. Note here, when we're off, we're still going to use that cash shortened over account. But what you need to do right now is, it's the end of August, and you need to replenish that petty cash fund to get it back up to $500. And here is what that entry looks like. Okay, it's August 31st. And we're gonna use the receipts in the petty cash bag. We're gonna hit office supplies for $380. Actually, looky here, office supplies and office supplies. We gotta add those two numbers together. So that's actually gonna be $402. Okay, then we have store supplies for $35. Then we have miscellaneous administrative expense. Wonder what that was. Maybe lunch meeting, food brought in, miscellaneous administrative expense for $30. Then skip a line and credit cash for $470. Now, let's go back in and put in our cash short and over short account. We were off by $3 here. So, in essence, here's what we've done. We've recorded the receipts. We've had to add $3 because we need to go to the bank and we need to get a $470 cash to put in our bag, because we only have we have $30 left in the petty cash, right? So when we go to the bank and we get the 470, we'll be back up to 500. Now, note something here. When did we hit petty cash? We only hit petty cash when we established it, okay? We did not hit petty cash again here when we replenished it, only when we established it, okay? That's kind of an important thing to remember. Okay, I have another petty cash exercise too that we'll do. So I will do the bank rec and the petty cash in a separate video lecture.